Good morning, ladies and gentlemen. Good morning. My name is Nathan Kowalski, and I'm the CFO of Anchor Investment Management and the president of the CFA Society of Bermuda. And I would like to offer you a very warm welcome for all our speakers and conference guests this morning. I'd especially like to thank all of you who have traveled from very far away to come visit our very beautiful island. We're very happy to have you. And I'm especially glad to see that you actually didn't get lost on the way. We have this little bit of a problem where people mysteriously go missing around our island. I don't know if you've heard the story. I'm obviously just joking, but not to scare you. Bermuda is, in fact, is a different world, a very beautiful world. We have approximately 62,000 full-time residents on the island. We offer 21 square miles of beauty with 75 miles of dramatic coastline. So I'd like you to all take a time to wander around our pink beaches and view our absolutely gorgeous turquoise water if you get a chance. And I also want you to all go visit our world-famous restaurants, our golf courses, and of course enjoy your hotel in the resort. And if you can, extend your stay because we're having some of the greatest golfers in the world come next week with the PGA Grand Slam. And step outside the door and look to your right out here later today, and you're going to see sailing with the Argo Gold Cup. And of course, open up your wallets and shop till you drop, please. We would love to have you support our local economy. It's very important. But I think one of the most beautiful aspects of our island is actually our people. I think you'll be hard-pressed to find a more hospitable group of people in Bermuda. It's actually not uncommon for tourists to stop a Bermudian to ask for directions and end up being asked over for tea. That's how open we are. And although we are a tiny island, we actually do tend to throw our weight around in the financial markets. So Bermuda is actually the third largest reinsurance market in the world, only second to London and New York. We have more than a third of the top 50 reinsurers based in Bermuda with major operations. And we actually command about 14% share of the global reinsurance market of non-life property casualty of all gross premiums written. Underwriting capital of over $116 billion and net premiums written of $58 billion in 2012 alone. So our financial success here has actually led us to have the fourth highest GDP per capita in the world, some 50% higher actually than the US. And that also brings me to another point. We actually have the highest per capita CFAs in the world. And as the president of the local chapter with some 200 members, I'd like to briefly draw your attention to the initiative put on by the CFA Institute called the Future of Finance. Part of the mission of the GIC is the expansion of global dialogue and free trade in order to improve cooperation and understanding amongst nations. This actually fits very well with the Future of Finance initiative where they're trying to shape trustworthy, forward-thinking financial industry that better serves society as a whole. So in a world where recent surveys suggest that only 53% of investors trust that their investment firms are doing the right thing, I think we need to really focus on this and move forward in our profession. So without trust, we don't have clients. Without trust, we don't have trade. And without trust, financial markets simply don't work. So I'd encourage you to visit the CFA Institute website, look up the Future of Finance initiative, and support it whenever you can in any of your initiatives. Once again, I'd like to thank you all for traveling, for coming to visit us at this conference. I hope you enjoy the conference. I hope you come to love our island like I do. So welcome to Bermuda, the jewel of the Atlantic. Thank you. And now I'm going to ask to come to the stage David Kotok, co-founder of Cumberland Advisors. And this is David's second time here. He keeps coming back, which I'm really happy about. He came in February, and it's a pleasure to have him back again. Thanks, David.
Let me add to the good morning from Nathan and do a little housekeeping, which will take about 2 minutes. First, many thanks to the City of Hamilton and Mayor Outerbridge and others in his administration for the hospitality that we will experience today and tomorrow. For CFA members, this is Continuing Education Credit Certified. There is a form in your packet. Who gets the form? Jill or Amanda? This is Jill. And where's Amanda? At registration. So to get the credit, you have to complete the form. Okay. Tomorrow morning is a session that is going to deal with state and local government debt, city debt. In case some of you have missed it, we have a very large topic in the United States now. And there's roughly 3.7 or 3.8 trillion of state and local government debt. Much of it is held by organizations in Bermuda as well as the rest of the world. And we are going to open that session beyond the existing registration, so there's room. See Jill or Amanda if you or colleagues would like to come. We'll be done by lunch. We have Robert Kurtner from Moody's, Catherine Mann on international flows into state and local government debt, Dennis Archer, the former mayor of Detroit, a city you may have read about. He'll give a perspective on the cities. And Mary Frankura, who is with Assured Guarantee, they are a bond insurer who she will discuss how they decide to insure cities. So it's a very powerful morning. And given the events of recent times, it's something you're invited to participate and be part of it. If you're not registered, we'll make room for you, please. This conference in the entirety will be videographed, and because of a firewall in this hotel, it will then subsequently be digitized and distributed worldwide through the Global Interdependence Center website. Normally, with things like this, we would stream and make it available to thousands of people around the world, but we're not able to do it. I don't understand why. I'm a Luddite, but in any event, we will. That's the plan. So there is a camera, and that's one of the reasons why we have to keep the light open. It may be difficult to see the slides. It's the best we can do. The slides will also be available to everybody on the GIC website. Our partner here is the CFA Society in Bermuda. Nathan, you and your organization are wonderful partners. We're really happy to work with you. This is the first time the Global Interdependence Center has a meeting in Bermuda, and we don't achieve meetings without help from sponsors. There's a long list of GIC sponsors and some GIC board members and organizations here. And specifically on this event, Allianz is a sponsor. And in the back of the room, I see Steve Sexauer. Raise your hand, Steve. Thank you for your support. I thank you for your friendship, and the GIC thanks you for the cash, because we need it. Thank you. And Anchor Investment, which is Nathan's firm, we thank you for your help and support. And Butterfield, where's, there he is. You're the culprit that started this whole thing years ago. Thank you for your help and support. We're going to start with a chart, one chart. The title of this meeting, which was originally designed 6 or 7 months ago, never contemplated the circumstances we would find ourselves in today. So here's a chart, and it's going to be difficult to see. That's why there's a copy in front of everybody. If you look at the extreme right-hand lower corner, what you see is, on this chart, and I apologize for the light, the white line is the 5-year credit default swap on the United States. Those of you who use it, trade it, or watch it know it trades denominated in euro, and the market is, the best market's made in London. And you can see what has happened to the pricing of it in the last few days. It has spiked 3 days in a row. The orange line or red line is the VIX. Those of you who trade stocks in the United States, look at risk and maybe use the VIX, will see that the VIX tends to run with credit default swap on the United States. As a matter of fact, some statistical work will show you that the CDS will lead the VIX by 2 or 3 days, not always persistently. The CDS is not as liquid a market, it's not as seasoned a market. And the third line is the Dow Jones Industrial Average inverted. So visually, when the yellow line is rising, the stock market is falling. And what do we see? Well, as we open this conference in this landscape, we have a minor squabble going on in Washington, D.C. And we have a credit default swap on the debt of the United States of America, which has reached levels which in the past has resulted in frightening shocks to financial markets. And we have a rising VIX. And until this morning, we had a falling stock market. Now there's a triumph of hope over reality in the futures market this morning. We'll see how that develops. So we have a fascinating landscape. When we sat here 6 months ago, 8 months ago, to put together a conference, we said we'll talk about the economic outlook, and we'll talk about quantitative easing, and we'll talk about the issues that we all saw then, never dreaming we would convene this meeting in the midst of this addition to the landscape. Which leads me to the introduction of this panel and a quick story. Because the panel is going to talk about the global economic outlook. And everybody seated at this panel is a Global Interdependence Center member, sponsor, participant. And I thank them all for making the trip to be part of this meeting. We'll let Vince Lowry, whose experience in indexing and worldwide investing, introduce his fellow panelists. They are an economic forecast panel. When we organized the meeting, we had a forecast. I want to say one word about forecasts. There's a Native American tribe in North Dakota. And the tribe was led by an old chief for many, many years, and the old chief died. The tribe elected a new young chief. The new young chief was a modern chief. He assembled the tribe. He thanked them for giving him the honor of leading the tribe. And it was in the middle of the summer, and the tribe said, "Well, Chief, what do we do about winter? How do we prepare for winter?" So he thought about it, and he said, "You know, the old chief never said a word to me about how much wood to prepare for winter. But now I'm the chief, I have to say something." So he says, "Well, I think the winter this coming year will be about the same as last year. Normal winter, we should prepare the normal amount of wood and stack it up for winter." So the tribe dutifully did exactly what they were asked to do. He started to think about it, and then he said to himself, "I'm a modern chief, and I think I'm going to use modern tools." So he calls the National Weather Service. They weren't shut down at that time. And he said, "Do you have a long-range forecast for the winter in the Dakotas?" And they said, "Yes, we do." And he said, "Well, what is it?" And they said, "Well, we think it'll be a normal winter, pretty much like last year." So he felt really relieved. Summer gives way into September, and the chief is worried. What if the winter's colder? So he calls the tribe together, and he says, "I think winter may be a little colder than we originally thought. I think we should prepare some extra wood, just in case it's colder." So the tribe goes out, cuts more wood, stacks up the wood. The new young chief then goes and calls the National Weather Service 2 weeks later to see what they say. National Weather Service says, "It's looking to us as if the winter's going to be colder than we originally thought." So he says to himself, "You know what? I'm glad I did that. It's October. first nip of frost. Now the chief's really worried. What if we're not properly prepared? So he calls the tribe together. He says, you know, we may have a very cold winter. I think we need more wood. Tribe cuts the wood, stacks up the wood. 2 weeks later, he calls the weather service. He says, what's your latest forecast for the Dakotas? And they said, we think the Dakotas are going to have a very cold winter, blizzard conditions, one of the roughest winters ever. So the chief is irate. He says, you know, what's the matter with you people? You gave me 3 forecasts in 3 months. What data do you use? How did you come to this conclusion? And they said, the Indians are stacking wood like crazy. We're going to have 3 economic forecasts. Vince Lowry, your panel.
Thank you, David. Thank you all. This is my, my first attendance to one of the GIC. I have to tell you, last night at dinner was the first time I had a conversation about the affordable health care, and the people on the other side of my view are actually well-versed and unemotional and made a tremendous argument. Didn't convince me. But you know, we talked a little bit about, you know, how's it all going to be paid for? And the conversation really got interesting when we talked about all these wonderful angels in the healthcare arena, doctors and nurses who are going to give us 15% more of their time and do it for less, and we're all looking forward to that developing. But we had a great conversation. It was much better than when I forced myself to watch an episode of Bill Maher, and he had a panelist on there who was explaining what was wrong with our healthcare system today. He said, you know, it cost $20,000 to $30,000 to get a knee replacement. And do you know how much that actual object cost? $150. And then they charge you $20,000 to $30,000. And the audience erupts like a home team football crowd with a touchdown. And then his next statement was, and we have to get those insurance companies who are just out there trying to get profits, getting in between us and our medical care. I'm thinking, wait a minute. Didn't you just tell me this doctor invested $150 and ripped me off for $25,000? Where the hell was the insurance company that was ripping me off? But this is what we hear out there. Today, I think we're going to hear, like I last night heard, much more educated views, and I think the panelists we have here, it's quite a lineup. We have Edward Keon, the Managing Director and Portfolio Manager for Quantitative Management Associates, which is an investment arm for Prudential, the insurance group. Along with him, we have Kathleen Stephansen, who is the Chief Economist and Senior Managing Director at AIG Asset Management. And maybe we'll get to hear a little bit about how Maurice is doing going forward. And also we have with us Duncan, the Chief Economist at Fannie, who's going to talk to us about transitioning to normal, which I think will really be interesting, being at the heart of what one of the sectors that the Fed is looking at in terms of their interest rate policies, because it has such a tremendous impact on employment. So with that, I think the format's going to be, we're going to ask each one of our panelists to spend about 10 minutes or so just giving a viewpoint of their view of the world and what they see. And with that, we'd like to try and stimulate some questions so that we can really have a really informative session here. So with that, I'd like to start with Kathleen. Would you like to kick it off?
Thank you very much. Good morning to everyone. So is it just to do like this and the slides just, where is it? Here? Thank you. Forward and Perfect. Thank you. So, starting with the program and looking at all the various topics that will be discussed: monetary policy, quantitative easing, inflation, growth. My slide deck covers quite a bit of all this, so what I decided to do is to just touch on a few themes rather than go through the various slides, and that will give you a flavor of where we think the situation currently is and where we're going. So it's a little bit like the blind leading the blind here, but we'll try to do the best we can. I would say a couple of words, a couple of observations. One is that in this current environment with mixed signals in the growth dynamics, with pro-cyclical fiscal policy, the monetary policy outlook is challenging, particularly for the central banks that conduct quantitative easing. When and how will they essentially exit this unconventional monetary policy environment? In terms of global growth, the dynamics remain essentially moderate. The reason being that we continue to see the constraint of ongoing deleveraging in some parts of the world or other types of structural reform. And regionally, I'm afraid that the center remains the two countries, the US and China. Yes, of course, we do have other dynamics at play, such as the recovery, the mild, timid recovery in the euro area, in Japan, a little bit more sanguine. We also have the slowdown in emerging markets. But really, the key dynamics here are what is happening in the US and China. And in the US, is emerging from a lengthy deleveraging in the private sector, but in terms of cyclical dynamics, is still extremely mixed. In China, what we're seeing is the post-stimulus slowdown, and that has unveiled some major structural problems, and the government seems to be eager to address these problems. So the question is, are we going to see a hard landing or a soft landing? And I would argue in favor of a soft landing, and I'll show you why. So turning to the next slide, I'm probably going to state the obvious. If you look at the one on the right-hand side, it's the Fed funds rate, the effective Fed funds rate. It's probably what the consensus expectation is, namely that sometime in the next couple of years, I have here second half of 2015, the Fed will try to start normalization. That's not the point that I'm trying to make here. What I'm trying to make is that if indeed we do see that, and we see a gradual normalization, we are reaching the 4%, which are roughly speaking the average, long-term average, by 2018. And to me, that really is a very humbling outlook, in the sense that it will have taken 10 years for the normalization to reach its point. It's 10 years of major structural changes, adjustments, of slow growth, and it really, I think, underscored the fact that for those who had anticipated a quick recovery, it really is an awakening call. It's very much mirroring what we've seen in smaller countries, the Nordics, for example, back 20 years ago. It's just a very, very slow and arduous adjustment that takes place. This, we can talk ad nauseum as to whether the central bank, the Fed, did the right thing to taper or not to taper. The point that I'm trying to make here with this chart is the fact that the Fed still plays an important role in the supply of liquidity in the markets, the Fed being the red bars. So you can see that if it weren't for the Fed, the liquidity supply would be much lower. I'm not suggesting that we need to reattain the levels that we've seen back pre-crisis, but it really shows that when the Fed is not in the game, then we start to see a significant slowdown in economic growth. And the QEs, if you will, of the last couple of quarters, the last point estimate there is Q2 of this year, really suggests that it's going to be tough for the Fed to end QE. In terms of the adjustments, just a reminder in terms of how difficult it has been. The top left-hand chart is the deleveraging, if you will, and you can see that the private sector, financial and households, the household is the light blue bar, has essentially run its course. The pink bars, the the federal government continuing to borrowing, and the gray bars, which you probably can't see very well, that's the corporate sector essentially restructuring its debt. But the good news is that we are towards the end of the deleveraging of the private sector, the household sector in particular. So what you're looking at the lower end, lower right-hand corner, is essentially the net lending or net borrowing, and it is as a percentage of GDP, which doesn't appear there on the title. But what this shows you is the shock that took place back in 2008 when the private sector essentially went from borrowing close to 4% of GDP to saving close to 10% of GDP. That's a huge shift, which would have dipped us into depression had it not been for the government essentially dissaving. And since then, what we've seen is a gradual thawing, if you will, in the private sector. So now we're looking at the dark blue line coming closer to zero, but not quite. It's at 3.3% of GDP. The average over the past 40 years is about 3.1. And of course, the question is, what is the optimal level for that? We need not be very close to zero. We need not be lower than the zero bar. But if that's a policy goal, then of course we have to calibrate what does mean for the savings or dissavings of the government sector. All this to say that even if the private sector has finished deleveraging, you start to see the government sector, the public sector, that will start. And that's a headwind for growth in the next few years. So the outlook in my mind is for continuation of moderate growth. This year, we're not reaching 2%. Next year, we're probably between 2.5%, 3% maybe. That's thanks to the fact that the fiscal situation might not be as dire, no sequestration, but we still have this long-term deleveraging that will prevent a much faster dynamic in terms of growth in the US. So the other slides that I'm going to skip, you will have them available for you, essentially are depicting the cyclical dynamics, which will show that, yes, we are doing better on the labor market, but it's not a very sharp increase or recovery. We're doing better for the consumer. You can see on the top left-hand corner, the wealth to disposable income is picking up, but that doesn't mean that that's going to be spent. And you can start to see, and I'm sure that Doug will talk more about the housing recovery, so I'm just going to skip those. Over here, investment, we are seeing some, I would say, improvement there. The left-hand chart is corporate profit margins against core durable goods orders, and that shows a pickup. and which is consistent with what you see on the right-hand side, essentially the ISM new orders, which also seem to indicate that there is a pickup in activity here. But the pickup is, again, within the context of moderate growth. I do not believe that we are going to see a massive increase like the one that drove us out of the recession 5 years ago. So I just want to move on. Essentially, the US doing okay. In fact, given these adjustments, is doing pretty well. But it will be a challenge for the Fed to exit quantitative easing. So let's move to the other side of the globe and take a look a little bit at China, because that's the other major player in terms of global growth. And there's been here quite a dramatic change, if you will, in the role of China, in the sense that no longer is China playing this massive demand impulse that we've seen and started to almost be accustomed to, that was taking place in the past decade. The slowdown, and I'll show you in the next chart, is dramatic, and it is also complex. The cyclical induced policy stimulus that we have seen just in response to the crisis has exacerbated some structural problems in China. And those structural problems are particularly an over-leveraged corporate sector. And it has led to low capacity utilization rates, and particularly in some industries, so that at the moment there is this absolute need to rebalance, if you will, and rethink the growth model. Now, the new leadership has been convincing in wanting to address this situation. And in my mind, I think it is possible to orchestrate a soft landing. So just to give you a visual example of the extent of the slowdown, you can see here on the left-hand chart the slowdown, so its growth rates in 2007 in the dark blue, and in the light blue, it's the growth rate of last year in 2012. The top one is China, and it went from 14% to 7.5%. In the middle there, you'll see emerging markets in general, and that went from growth rate of 8.3% to close to 5%. So a very significant deceleration in growth. And this is in response, again, as I mentioned, to the reversal of the fiscal stimulus and the constraint in credit that we've seen since then. What's interesting in the dynamics, and there will be another chart that will probably show that better, is that when you had the growth stimulus out of China, the idea, I suspect, in the global cyclical dynamics would have been for advanced economies to pick up the growth baton that was essentially put into place by this growth stimulus. But advanced economies were not ready for it because they were in the midst of massive deleveraging. As a result of that, you saw a deceleration, and you can see that in the lower right-hand corner chart, which is Chinese exports on a year-on-year growth rate in light blue and global trade in dark blue. You can see that it decelerated quite dramatically. And this has led then to this dynamic of a slowdown that we're seeing even today in emerging markets. So let's talk a little bit about these structural changes in China. Well, the over-leveraged corporate sector, as I mentioned, is a byproduct of this stimulus that was put into place. And what we've seen, and we observed, and you can see that on the left-hand side, the red line is the credit growth, and the gray bars are the GDP growth rate on a year-on-year basis. You can see that as we progress, essentially GDP growth is no longer responding to strong credit growth. Productivity gains, demand growth have lagged behind the credit expansion. And on the right-hand side, these gray bars shows you how much of leverage you've seen in the major industries, whether we're talking, and these are heavy industries, ferrous metals, utilities, petroleum, and some others. So it really shows that in order to address the situation, the first thing that needs to take place is to cut production capacity. And in 19 industries, we've seen that happening. So this, of course, has a downside risk to growth. And that's the reason why the government is now looking at structural reforms. And taking a page from Japan, in terms of the three arrows, the Chinese leadership has essentially looked at three different components of this structural change: deleveraging, no large stimulus, and then the structural reforms that take a whole array of them. And you can read those at your leisure in the hard copies or the ones that we find online. But by and large, what all this is saying is that you start to see a shift towards more of a consumer-based type of economy. This is nothing new. Since 2004, leaderships have tried to shift that dynamic, but you can see that there is quite a bit of upside, if you will, to consumer spending. Look on the top right-hand corner, the sectors as a percentage of GDP. The arrow there shows you that the dark blue, which is consumption, is likely to rise. And just as a comparison to other emerging market countries, China in red in the bottom chart consumption is only 38.5%, whereas in Brazil, the first bar, or you take others, even India, Russia, they are above 50%. So there is here quite a bit of an upside momentum that can take place with the right policy. So the question is, well, are they going to be successful? And for that, we need to see a soft landing, which means a 7.5% growth rate over the next few years, as opposed to the continued deceleration towards 3%, which had been the talk of the market not so long ago. The reason why I think it is likely to be successful is for the reasons that I've listed here, whether we're talking growth stabilization, recovery in advanced economies, pulling a little bit, in the global growth, tight labor markets, et cetera, et cetera. I'm going to skip a few because I don't want to overstate my welcome at the podium here. But just to give you an example in terms of the consumer power, you see the top right-hand chart, which is the retail sales on a year-on-year basis. It's been averaging 20%. And the lower left-hand chart is the wage dynamics. The light blue is in real terms. And you can see it's been averaging above 10% year in, year out. So essentially providing here more purchasing power, if you will. In terms of house prices, that's been a real question as to whether this is a bubble. I would argue that it depends really on some of the cities, but the dynamic is driven by what you see in the lower left-hand corner, namely the ongoing urbanization process in China. Risks, of course, there are many risks. But by and large, we would say that with these dynamics in place, we think that the soft landing is quite likely to be reached. I'm going to skip over Europe and Japan, not because I don't think a lot about them, but just for the sake of time, and just move to the conclusion that if you agree with me that you have soft growth in the US, that you can see a soft landing in China, then global growth is set to be steady, but weaker than what we've seen just prior to the crisis. Zero in on the top left chart, which is global growth. And you can see we are in the lull, if you will, in past the recession. And this lull is precisely the dynamics that I described to you just a moment ago, that you had the stimulus from China that didn't essentially help out advanced economies, if you will, because they were in the process of deleveraging. That deleveraging process is maturing in a very convincing way. So now what we're seeing is a pickup in advanced economies. And if you move to the top right-hand corner, which is the depicting the manufacturing purchasing indices for advanced economies in blue and emerging markets in red, you can see that the pickup in advanced economy, that rotation is taking place. What this is likely to do is help global growth, and emerging markets will then follow, if you will. So that over the next few years, what you're likely to see is what you have at the bottom left, namely that emerging markets will continue to outperform advanced economies in terms of growth. That's the spread between the two regions, if you will, but you're not going to see the type of spread that we saw prior to the crisis when it was 5 percentage points or so. It will stabilize around 3%. And that's good news, because you're not going to see the tension in commodity markets the way we saw it just prior to the crisis. And this will allow for this transformation that you see on the bottom right-hand corner, namely that consumer spending, the consumer share, if you will, for emerging markets will continue to rise. What you have there in the light blue line is emerging market consumption as a share of global consumption, and the dark blue line is the US consumption as a share of global consumption. And that's declining, and we've already seen the two crossing, and it's the dynamic that is likely to be the overwhelming growth, there will be the overwhelming model, if you will, for the next decade or so. And with that, I thank you for your attention, and I think that we are keeping the questions for later on. Yes. Is that right? Thank you.
Thank you, Kathleen. I'm hoping we can get a copy of that. That's very interesting. Thank you.
All slides will be on the GRC website.
Oh, great. Thank you. To move along, I wanted to ask Ed if he would speak next from Quantitative Asset Management, and then we will follow up with Doug after that.
Thank you, Vince. Clearly, the situation in Washington is enough to drive a man to drink, which is probably the best thing I can say about it. And I have to say, my team manages about $50 billion in asset allocation funds, and over the past week or two, we have been very heavy sellers of stocks. And we've moved most of that money into cash. However, we're still overweight stocks. So we've gone from a very big bet on stocks to a very small bet on stocks. And the reason is that, although I'm very nervous about what might happen over the next couple of weeks and months, I'm actually quite optimistic about what might happen over the next 2 or 3 years to the U.S. economy. So what I'm going to do for this morning is focus on that more optimistic outlook and the reasons behind it, rather than on the short term. And I think the key to thinking about the U.S. economy right now is to try to figure out how things would have happened if we hadn't started off the year with a tax increase of about 1.3% of GDP, as well as big cuts in spending at both the federal and the state and local level that knocked roughly 1% out of first half GDP. So of course we don't know that, it's a matter of speculation, but the best research in that area is by Christina Romer and David Romer, which found, looking at a lot of different periods over time, that a 1% increase of taxes relative to GDP amounts to about a 2 to 3% drop in GDP over the subsequent 10 or about 10 quarters. And given the current circumstance, I had an opportunity to chat with Christina briefly, although I don't mean to imply by any means that she endorses what I'm about to say or how I'm going to torture her research over the next few minutes. But that probably that 10-quarter period has been more compressed as a result of the weakness of the economy today. So if you look at U.S. GDP over the past 4 years or so, what do you see? You see that growth has been around 2%. It's sometimes been a little above that, sometimes been a little below it, but it's been about 2% for 4 quarters. So you'd say it's still about 2%. It's likely to remain 2% for the foreseeable future. But I would suggest that if we had not had a gigantic tax increase to start the year and continued dramatic fiscal drag for the state and local as well as federal level, that the GDP would already be looking quite a bit better. And one way to think about that is to separate out GDP into the private economy versus the overall economy. Private economy in the second quarter grew 3.3%. And that, again, that's despite the fact we started off the year with a big tax increase for everybody. Payroll taxes went up for everybody, income taxes went up for higher earners, and many other small taxes were added in as we started this year. So if I take Christina's numbers, probably we might have been growing in the private economy by something closer to 4% in the second quarter if we hadn't started off with such a gigantic tax increase to start the year. So I think that under the surface, despite the fiscal drag, the underlying strength of the economy is actually getting better. And it's getting better more dramatically and likely to continue to be accelerating over the next couple of years as the fiscal drag wears off. Now, I have to throw in the caveat that that's assuming that we work out our current difficulties sometime over the next couple of months, which is not a sure thing. But if we can, and if the result of those difficulties is not a large immediate tax increase or not a large immediate spending cut, but rather something that works in over time, I think there's a pretty good chance that sometime next year we could see much faster GDP growth. I mean, I think if you're an optimist, you say something like 3%. I wouldn't be surprised to see 4, or even conceivably for maybe 1 quarter, if we get some luck on an inventory build, something closer to 5. So where's that going to come from? Well, I would argue that the first part of it is that old standby pent-up demand. So the easiest way, and of course we're going to hear a talk tomorrow about Detroit, so in honor of that, I thought I'd talk about the auto business. So if you look at auto sales in the United States over the past 20 years or so, you see that between about 1998 and 2007, we sold about 17 million vehicles, pretty consistently over that kind of 10-year period. Then during the financial crisis and the Great Recession, that number dropped below 10. Now it's back up to about 16 or so. So if you assume that we really would have liked to continue at about 17, and you look at that V and you say, how many vehicles does it take to fill up that V of drop in demand? The answer is about 20 million. Now, part of that is demand destruction. So that's miles that we didn't drive to jobs we didn't have or vacations we couldn't afford. Part of it is that cars have been getting better. So the average age of cars on the road has been slowly rising over the past several years, even before the Great Recession. But now it's up to about 11 and a half years. So if you think about where we are today, we're buying about 16. You go back 11 and a half years, we've been buying 17 and had been buying 17 for a few years before that. Over the next couple of years, we're going to have to not only get back up to 17, but get above 17. Otherwise, the number of cars on the road is going to go down, which is just un-American. So it seems to, so that's one industry. It's a very big industry. It's one industry, but it's one industry where we have very good data that goes back a long time. So it seems to me that a similar thing is occurring for washing machines and furniture. There's a significant amount of pent-up demand in the United States for durable goods and other consumer goods and services. So how are you going to satisfy that demand? Well, the two things you need to have are wage growth and employment growth, as well as the access to credit. So on the wage and employment growth side, there's one of the interesting dynamics about this recovery, which of course has been weak by historical standards, so perhaps not untypical in the wake of a financial crisis, is that the unemployment claims, although we got an anomalous number this morning just reported, have been going down. If you adjust unemployment, new claims for unemployment benefits for the size of the labor force are actually down near trough levels. But the unemployment rate is still remaining quite high. Ordinarily, those two things, if you look at those two numbers, they actually track each other quite well. What it suggests is that in this recovery, the problem hasn't been so much that people are being let go at a high rate, it's that the rate of hiring has been very slow. The same thing is true if you saw Kathleen's charts about investment. The rate of investment income has been relatively slow compared to other metrics like profits and so forth that ordinarily would drive it. So the businesses have been acting in a quite cautious way over the course of the last several years, waiting for evidence of demand rather than anticipating demand, which would normally be the case in a part of recovery. Is that going to change soon? Nobody knows for sure, but I'll offer, I'm a quant, but it's always better to tell stories, so I have two data points from an anecdotal point of view that I'll, of course, take those two data points and make it into a forecast. Twice in the last couple of months when I've been traveling, once in Chicago, once in San Francisco, we showed up at the rental car counter and they didn't have any cars. And not only did the company that we do business with didn't have any cars, but none of the other companies had any cars. So it may have just been bad luck, but it may also be evidence of a lack of investment in business, which is going to result in angry customers and lost business. So if everybody doesn't buy any cars in the rental car business, then they're all hurt roughly equally. But sooner or later, one company says, you know what? If we could buy an extra 10,000 cars, we would be gaining market share. And once that happens, the dynamic starts to pick up. So we haven't been in that cycle yet, where there is a rush to catch up to an underinvestment and underemployment over the last several years. But my guess is that we're on the verge of that. Credit conditions are still constrained, but based on the Fed's surveys, demand for credit has picked up substantially, and the credit conditions are just starting to loosen a little bit. I would suggest actually that somewhat higher interest rates might help credit. That is, it may, obviously if you're looking to buy a house, higher interest rates make it harder to afford the house you had in mind, but maybe you have to downside from that 4-bedroom house to a 3-bedroom house. But if credit availability improves as a result of higher interest rates, that has been the thing holding us back. Not so much the cost of credit, but its availability. I think that's starting to get better. And then finally, one of the things that it's obviously not going to have as dramatic an immediate impact, but more of an intermediate term impact, is the dramatic change in the U.S. energy picture. At least there's a few of us here that remember the 1970s. And I remember when, in 1973, when we first had the first OPEC embargo and the rapid rise in oil prices, the conventional wisdom initially was that the impact on the economy would be relatively muted, because if you took the oil percentage of the economy, you factored in the percentage that came from OPEC, and you did all the math, it didn't look like it was all that big a deal. But it turned out to have a dramatic impact, not just because of the immediate impact of the cost of that particular oil, but it raised the global price. It caused race disruptions as a result of shifts in relative income within the economy. It changed the dynamics of the global economy, and we've been living with that for 40 years now. But it's actually starting to go the other way. It's starting to go the other way fairly dramatically. We were having a conversation last night at dinner. It seems to me that if there is a large infrastructure project that both parties conceivably could get behind, it would be a dramatic build-out of the use of natural gas in the United States as a transportation fuel, which is where we burn most of our energy. Although natural gas obviously is carbon, it's still much cleaner than gasoline. And it's the kind of big imaginative project which I think could be a source of jobs in the short run as well as in the long run. And that the technology to do so certainly is in place if we have the will and the capital to do so. So I think it's quite possible that although the immediate future is still rather cloudy, that if we could just get Washington to leave us alone for a while. I've been trying to think of an analogy for this, and the first one I did involved a certain political figure, so I decided to let that one go and suggest that it's a little bit like the end of Gladiator, when, if you remember the movie, the emperor stabs Maximus in the ribs in order to even out the odds of it in the coming fight. So Washington's essentially been stabbing the economy in the ribs and saying, why is Maximus not fighting so well today? If they just stop stabbing us in the ribs, I suspect that the underlying strength of the economy will shine through, and that we'll look at the U.S. economy, and I think by extension the global economy, much more favorably 6 or 12 or 18 months from now than we do today. So let me stop there and pass it on.
Thank you. Thank you very much, Ed. I guess that's the reason why we need less of government, huh? I think now, speaking of quasi-government, I'd like to introduce Doug. Doug is, chief economist at Fannie Mae, and I think his insight's going to be really interesting, particularly with his view of housing and how that might affect unemployment and how that affects the Fed.
Thank you. It's great to be here. It's also distracting sitting up here and looking out the window and thinking of a number of analogies for a healthy economy, like ample liquidity, smooth sailing, a steady hand on the tiller, a bunch of things like that. So let me come back to reality here for a moment. I do have to follow up on David's comments on North Dakota. I have a brother who lives in Bismarck, and he recently flew to Washington, D.C., leaving Bismarck at 5 a.m. To change planes in Minneapolis to come to D.C. And he said the flight from Bismarck to Minneapolis was noisy, and it was all Southern drawls. And then from Minneapolis to D.C. was quiet. And from that, I would say that modern chief would, in fact, be storing up oil or gas as opposed to wood, given what's going on in North Dakota. He also assures me that he's very happy that his daughters are married and out of the state at this point. So let me talk very briefly, first about why this title, and I'm not going to go through a whole bunch of slides. I've got a bunch of them there. They'll be up on the website. I'll pick out maybe 5 to comment on. This year, our theme, each year we try to think at the beginning of the year about what we think will be the dominant theme of economic activity. Obviously, given our place in the economy, housing is a large focus. But we chose this transition to normal, putting normal in quotes, because we felt like the crisis may have altered some benchmarks that we traditionally would have thought of in ways sustainably, or so that they are not the same benchmarks as they were in the past. And it's not clear that transition will end this year, but that it's going to be an ongoing process. And we're a little uncertain about, if you think about GDP growth, exactly what will be normal going forward. We survey consumers on a monthly basis we survey 1,000 of them monthly. And one of the questions that we ask is the economy on the right track or the wrong track? So this will be on the quiz. Where in that time frame do you think was the last time that we talked about the debt ceiling? So the public does not like the discussion of the debt ceiling. In the 2 months in 2011, when that discussion was underway, the percentage of people thinking that the economy was heading on the wrong track rose 14 percentage points to the peak of about 76%, or 3 out of 4 households felt the economy was heading the wrong direction in the midst of that discussion. So what we've seen in the data the last 2 months in the housing stuff is there's been a pause, partly impacted by the rise in rates, which I'll talk about in a moment, but also partly the rising discussion of this fiscal argument, which let me take the comments by the 2 previous speakers and put them into a little bit of a context here. One is the discussion of privately deleveraging moving towards some completion, but that's been accomplished in large part by public leveraging. And if you are in agreement with the idea that the level of government spending is an indication of future level of taxation, then you would have in mind part of the reason why the small business community is not hiring people very much, because their taxes have already been raised and they might be looking forward and suggesting there is more to come in that time frame. And I think that's what the public argument is about. in Washington today. So let me suggest that another backdrop piece of information with regard to why we don't have strong economic growth prospects in our mind is this chart, which is the 6-month forward expectation of income growth of households put up by the Conference Board. So it nets out those who think their income will rise from those who think it will fall. And there's a group that runs between 65 and 70% at all times that thinks their income will be roughly the same. So if you take that out and net the other two, what you see is in the current period, it's sort of unprecedented, the lack of optimism that people have with regard to their future incomes. Now you have to take out of that some tailwinds that have run their course. One is the boomers, the growth of the boomers. At the back of this chart, they would have been in their 30s, so it would be reasonable for them to expect continued income growth for some time. It's also the period when the participation of women in the workforce was rising rapidly, and it has now peaked. It's also the period when the democratization of credit was broadly expanded. So all of those were tailwinds which have exhausted themselves in our mind at this point. So that's one of the reasons that we have relatively modest expectations for growth going forward, though I would agree that the energy story is a very positive story, and I think it also relates to the manufacturing story in terms of potential for the U.S. economy. So I'm not a pessimist. I view myself more as a realist. There are some significant forces that we have to deal with going forward. Let me jump to housing by going through the Federal Reserve. So as I pointed out to our board back in, I think it was March, when the minutes of the previous meeting were released, the Fed had talked about needing to talk about the end of QE, and for 4 days there was instability in capital markets. So that was simply noted that we need to talk about this. They didn't actually talk about it, but at that point we saw 4 days of instability. So I said, look out. When they actually talk about it, you're likely to see a reaction. And certainly when about 3 months ago the chairman made some fairly direct comments about that, we started to see the rise in rates. They rose about 100 basis points, and I think that's part of why the Fed has decided to continue its purchase program, which their total purchases are not just the $40 billion but in mortgage-backed securities, but rather they are also replacing amortization, they're replacing prepayments through refinancings, and they are replacing principal that is exhausted by default. So their actual purchases on a monthly basis are a lot more than just $40 billion. And in today's environment, they're more than all the net new production. So they're essentially at a posture now where they're purchasing out of other portfolios in addition to purchasing essentially all of new production. As I noted, that rise in rates led to significant concern about what would happen. We took a look at past periods, then there are two, when there was a rapid rise in mortgage rates in a short time period. The first of those was 1994-95, and in that time period, in 14 months, mortgage rates rose 240 basis points. So what happened? The number of homes sold fell, house prices rose, just not as rapidly, and there was a spike in the use of adjustable rate mortgages. Then in 1999-2000, over a 19-month period, mortgage rates rose 180 basis points. There was a flattening in home sales. It was a longer period and not as much of a rate rise. House prices rose, just not as rapidly, and there was a spike in adjustable rate mortgage use. So you would suggest from that, if you took that on its face, that there's not really a threat to house prices. But there are two fundamental differences in today's time period. In those two previous time periods, the Fed was exercising the normal or traditional monetary policy tools focused on the performance of the macroeconomy. Today, the Fed is focused on normalizing, or the discussion of QE is a discussion of normalizing its balance sheet relative to the macroeconomy. That's very different than those other two time periods. In addition to that, the rules associated with underwriting adjustable rate mortgages have changed, so that today you have to underwrite those mortgages at the maximum rate to which the interest rate can adjust in the first 5 years of its life, which is essentially what fixed rate mortgages are going at today. So that affordability tool is no longer available to consumers to ride the change in the shift of the yield curve. And in addition to that, at the exit strategy for those other two time periods was in the longer term trend of disinflation behind the economy, which is at this point really over. So there are some fundamental differences in place today that are a reason for the Fed to be concerned about the rise in rates and the change in its posture. So in talking about this transition to normal, one of the things that we looked at is what's the largest contribution of housing to economic activity, and we did an assessment about how construction should be proceeding at normal demographic levels. And our conclusion is adding multifamily units, manufactured housing units, and single-family units, we should be producing for the period 2015 to 2020, on average, about 1.76 million units. Well, this year we'll produce about 930 or 950,000. At the beginning of the year, we took a lot of heat for that forecast because the consensus was well above that, but it's running very close to what our forecast was. And it's not a fancy model, it's an observation about what has to happen for the market to function. First of all, in the course of the crisis, the public builders had to release land options and sell land to stay in business. So the first thing they have to do is acquire land. The second thing they have to do is get that land permitted, and there are jurisdictions where that alone can take up to 3 years. Third thing that they have to do is they have to acquire labor. And the sector that laid off the most employees in the course of the crisis was construction. And those people weren't probably just sitting around for 4 years waiting for that job to come back. So they're going to have to encourage that labor back. And then you have to look at all the input suppliers ramping up input production in order for construction to proceed. So it looks like this year will be somewhere in the 950,000 units, which would imply that to get back to normal, we'll have to see a growth annually of over 200,000 units, which is a pretty aggressive growth path just to get back to that average. So our view was, even though we were viewed as pessimistic, that outlook to get back to that normal level could easily be characterized as aggressive. And we would say that the one other thing to keep in mind with the rise of house prices, and I'll finish with this, and you can bring up what other questions you'd like to hear about housing in the Q&A section. The rise in house prices today has been, in our view, almost exclusively a function of supply conditions rather than growth in demand. So what are those factors? One of them is the seriously delinquent loan population is still about 6% of outstanding loans, whereas normal would be somewhere between 1.5 and 2. All of those households are unavailable to offer those properties into the supply side of the equation. You've had institutional investors have gone into some markets and creamed off the bottom part of that supply, and you've seen rapid price rises in those markets, since if demand stays relatively constant and you issue supply shocks, price must go up, and that certainly has happened in places like Phoenix and some other jurisdictions. I told you about the slow ramp up in construction, adding to supply, and we still have some 5 or 6 million households at least that owe more on their home than it's worth. So one of the questions that we ask in our survey is it a good time to sell a house? Because 5 out of 8 people who are going to buy a house have to sell one first. And that number, which was flat at 10% for the first 2 years that we did the survey, is now up to between 35 and 40%. So the majority of people still think it's a bad time to sell a house, which from our perspective also impacts the supply side. And so you can see, if you look at that supply, it's highly correlated with the change in price today. So this is not a demand side factor. Our view is housing is on a growth path. It's sustainable, but it's not robust. We don't expect it to be robust for at least another couple of years. So let me finish with that, and then I'll take whatever questions people are interested in. Thank you.
Thank you, Doug. Thank you. Okay, we have about 16 minutes left for questions. First, I'd like to open it up to the audience, but I did want to sneak one of my own in first, if I could. So I've just opened this to the panel. I'm going to give you a simple-minded view, being on the buy side of bonds with my clients. And I read the San Francisco Fed felt the quantitative easing was keeping interest rates down about 50 to 55 basis points across the yield curve. Is the Fed actually slowing the economy up by banks and other investors not wanting to loan, or we're not worried about credit risk, we're worried about interest rate risk? And that those artificially low interest rates are really preventing banks from making loans and from normal other investors pushing money out into the credit markets. Any opinions on that?
Let's say argue that the higher interest rates might actually help the supply of credit. I guess I have to say that the answer is, I think, yes. But I think you have to balance it out. So the key to QE in my mind is, at what point do the banks take their rather substantial, over $1 trillion balances at the New York Fed and turn that into loans? So there's been this trade-off where you get some benefit by having lower interest rates, but you also get the negative side, which you just pointed out. So my guess is, first of all, we know that QE is going to end next year at some point. And so at some point that question will be moot. And I think what you'll see is that money that's now sitting at the Fed is going to actually be put to work. And that will be part of the reason why economic activity, when it starts to accelerate, will accelerate at a pretty rapid rate. But that's still probably a good 6 to 12 months off.
Great. Thanks, Ed. Kathleen?
I think that QE has been a very important dynamic in the recovery of the economy. It has allowed for the risk aversion to essentially turn around, for asset prices to rise, for helping, in fact, the household balance sheet. And so it was a necessary condition, I think, for the recovery. It is essentially the only tool that has allowed for the role of a buffer, if you will, when fiscal policy was extremely constraining. It's not that this is a tool that will spur growth back to its long-term trend. That's not the issue here. The issue is that it is a safety net, and a powerful safety net that has helped, if you will, some of the sectors.
And thank you, Kathleen. Would you like to find Doug?
I think that the data are pretty clear that QE1 was effective and needed. I'm less convinced that the current iterations are being effective, and I do believe that one of the things that has to be put back into the market is the duration that the Fed took out of the market, and also the volatility, both of which are important price tools or price setting tools. And I think the longer we go without restoring back into the market those very important components of establishing a valuation across capital markets, we will actually slow the pace of recovery.
Thank you. Thank you very much. Do we have anybody in the audience that has a question?
This is a general question, but I'll start with that. I liked your optimism for the recovery. I personally share it. One thing you didn't talk about, which is maybe alluded to here, was the reserves that the banks have that you just mentioned come back into the economy, come back in rapidly, are estimated to be roughly 19 times the statutory reserves. So what is the dynamic when the Fed tries to slow that process and moves interest rates up or rates go up rapidly?
Well, I personally don't think rates will go up rapidly. I think there's still enough genuine demand from individual investors and insurance companies and other actors to keep rates from rising very rapidly. There's a piece one of my colleagues did recently that went through all the numbers and suggested that there's still enough genuine demand, taking out the Fed demand, to keep rates from rising at a very rapid clip. But I do think they'll rise. I think we'll probably, the 10-year, to pick a number, I think we'll rise over 3 and approach 4 sometime over the next couple of years. But as long as the rate rise, if I'm right, that it's gradual, I suspect the economy can absorb that just fine. And you'll have the double dynamic. On the one hand, it will, for borrowers, the rise in rates, even if it's gradual, will suppress demand, but at the same time, it will increase supply. So hopefully have a more healthy dynamic between the availability of credit and the cost of credit over the next 2 or 3 years as we get back to a more normal level of economic activity and a more normal interaction in the credit markets without the heavy hand of the Fed.
Anybody else on that? Any other questions that we?
Do you really feel that that quantitative easing can come to an end in a period that is going to be marked by 2 major elections, and separately in a way, but very linked to that question, do you feel that the Fed has become just another political institution?
Somebody want to jump in there first? I guess was that to Doug? I guess you.
I'm not running for office. I'm not interested in running for office. I won't run if I'm drafted.
If nominated.
Exactly. Yes, I think on the 100th anniversary of its existence, I think the Fed has a real challenge, whether it's just the optics or it's the reality of the intersection between monetary and fiscal policy. In fact, I just reread a paper written by a Norwegian economist on the 1951 accord between Treasury and the central bank on separating the roles of monetary and fiscal policy. For those of us who are econ geeks, it's an excellent read, but it gives you, there are real strong parallels in the political versus monetary policy choices that are being made. So I think that is going to be a challenge for the Fed going forward, and we really don't have a modern precedent or a modern memory of how those discussions go, because you certainly have in Washington today one strain of thought that says, well, Fed's monetary policy is just making it easier for the managers of fiscal policy not to make the tough choices. And it's a trade-off between short-run and long-run objectives.
Thank you, Doug. I think we have another question here.
Hi, thanks for the great presentations. I heard a lot about normalization, and at some point we're kind of going back to a normal economy, but I didn't hear anybody specifically mention demographics, especially in Europe and the US. And if just drawing from the Japan experience, how they've had low rates for forever almost, for decades, is it possible, is there any probability that the US sort of goes down that road rather than this normalization road, in your opinion, and whoever wants to answer?
Maybe Kathleen, it sounds right up your alley there.
I think that's a very good question, and one thing is that in my opinion, it will play a role going forward in terms of being a dampening, if you will, in terms of the backup in long-term interest rates. as the aging of the population in the US will demand products, fixed income products, so it will have a dampening effect from just purely a demand shock, if you will. It won't necessarily have to go down the Japanese path simply because of the dynamism of the US economy and yes, the immigration, even though there is, I think, room for action there, but it is a more active, it has a more active immigration policy than, for example, Japan.
We are very interested in demographics, of course, because of it's tied to housing activities. So the two or three things. One, we took a look at to get back to normal construction, how many jobs would be in housing relative to what were in housing prior to the crisis, and that will add 1 million less jobs than it did at the peak. So the rest of the economy is going to have to add those. Now, some of those were immigrant workers who went home, and so we took a look at the 2008 current population survey and compared it to the 2012 current population survey and projected that out to 2050 labor force. And if immigration isn't restored to prior levels, you'll have 15 million less workers in 2050 than you would have thought. So that certainly has an impact on the demand curve for housing, but it also has an impact on the difficulty of entitlement reform. So I think there is a big stake for the economy broadly, not just housing, but the economy broadly in what we do in terms of immigration reform. So it is, if you take out immigration and birth rate of immigrants, the US population is not at replacement from domestic births. So we're one of only 4 Western developed countries who have positive labor force growth expectations through 2050. Japan they're the poster child. Their birth rate of replacement is 2.1, they're at 1.3, and they don't allow immigration. Ours is a very different circumstance, but what we do in immigration is going to be important to that future.
I'm always on the lookout for non-consensus views, and I can't endorse this because I've just seen the report, but if those of you who have access to BCA research, they did a report just in the last month that actually argues that we're going to have a new baby boom, and then there's some evidence that's already underway, and the key to it is understanding that the age at which women have children has gone up dramatically. So when it comes to measuring the dynamics of population growth and the number of births per woman and so forth, we need to kind of shift our historical norms because of the older age at which women are typically having children. So it's if you have access to that research, I would suggest looking at it because it certainly is a view that I was not aware of before that, and it's one that's certainly outside the consensus at the moment.
We have time for one more. We have somebody in the back by the...
Thank you. So today's program, the evolving market landscape, if we tweak that a teeny bit and we ask about the evolving job landscape, do you see recovery in jobs lagging behind the recovery in the market?
Well, it certainly has so far. If you look at the JOLTS report, assuming we get another JOLTS report again, the openings basically have been flat for quite a while, even as the quit rate is rising and the people getting fired is going down. So we have not seen the kind of acceleration of jobs in this cycle so far that you ordinarily would in this kind of this stage of the economic cycle. I suspect that will change, but it's going to take a while. There's been a consistent sense of conservatism among businesses, both small and large, as opposed to hiring in advance or anticipation of an increase in demand. They wait until demand has already hit them, and they absolutely have to have more people. So it's going to take a while, but I suspect that the labor market, when it does start to tighten, might tighten fairly quickly. Partially for demographic reasons, as more baby boomers start to retire, you might see that the dynamics of the labor market, say 2 years from now, look very different than they do today. If once hiring starts to pick up, the constraints of the expansion of the labor force, because it is growing relatively slowly, we could see tighter labor conditions sooner than we think.
Comment?
I must say that I find the recovery in the labor market puzzling, not so much in terms of the headline numbers. We can understand those with regard to, as you just mentioned, the slow recovery in the overall economy. However, when you go into the details, what's interesting is to see that jobs growth among the older population has risen compared to the younger one between 16 and 50 or so. So it's puzzling to see that, and a bit alarming in the sense that you have to ask yourself whether there are some structural changes versus just merely the cyclical one in terms of the educational profile and so on. And whether, when you look at the employment ratio, the population ratio, you can see that the economy is simply not capable of producing those jobs.
Let's thank the panel. Great start. A lot of meat. All slides will be on the Global Interdependence Center website. Load quickly, clearly, and Jill will give you her home phone number if you have a problem. We're going to break for 15 minutes for coffee, and since we planted the seeds about QE and the Fed, the next session is on the Federal Reserve. Thank you.
Hey, nice job. Thank you very much. Nice job. Thank you.